So everyone, thank you for joining us today. Hello. This is Excelling in E-Commerce, Master 2023 by looking back at 2022. So that's what we're going to do today. A quick housekeeping note beforehand. I bet this is not your first webinar, but for the best experience, I recommend, if you've got Google Drive sync in the background or something, maybe pause that. The only other thing that I really want to say is that there is a Q&A, and please use it. Just don't hesitate. It's anonymous. People can't see what you're asking, so feel free to ask very freely. And we have a no questions left behind policy, so we will, if we can't cover your question today, then we want to follow up with you after. And then just one word quick about the format. That's another thing. Like, you've probably been in some webinars by now. We have two, and we want to just try and mix it up a little bit to have a webinar that doesn't feel too much like a webinar where it's, oh, Chris, you do this slide. Now I'll do that slide. And then the whole thing secretly a sales pitch or whatever. That's not what we're here for today. We just want to have more of a conversation and talk about some interesting data together. And yeah, keeping it loose like that, if that makes sense.
And I think that's a perfect segue, guys. My role today, first of all, Mike, it's always an honor sharing the virtual stage with you, because you're a true expert in the field of e-commerce. So my role today is a pretty simple one, as Mike said. I think it's all about having conversations and takes on our data points. Although our data points are pretty rich, so we're talking about 1.3 billion data points we analyzed to come up with I think very interesting insights. However, this is just a fraction of the overall market. So I think it's fair to have maybe even different takes on certain things, and that's what we want to highlight today. We want to walk you through really interesting insights, and it might even end up in some controversial discussions between Mike and me. We know each other very long, so no hard feelings, Mike, if I have one or two questions there. And yeah, ladies and gents, my name is Christian Schamüller. I'm now, I think, even the 12th year at SMAC. To be honest, time flies. I don't even know for sure anymore. And yeah, basically, I'm responsible for existing and new client business in my role as Chief Client Officer. And I'm really looking forward to the next roughly 40 minutes.
Yeah, thank you, Chris. I've been at SMEC for 6 years, which is as long as I've been in e-commerce and digital marketing now. Before that, I was in offline retail, doing retail operations like purchasing, electronic catalog, and inventory management, and a lot of interesting stuff like that. But really glad to be here with you all today.
Yeah, and before we jump right into it, just a few words about us as a company, because I think it's somehow important to show you what we're doing all day long, because it somehow, of course, also validates the numbers we bring to the table today. So Smart E-commerce is now, what is it, the 15th year in the e-commerce market. We were founded in 2007. We have roughly 360 clients. We have roughly around 120 specialists. The numbers are not fully updated here regarding that, and fast growing. And yeah, we basically manage roughly 5 billion annual revenue generated for our clients. So that is also the reason why we have really rich data points, because we have a very, very sufficient and rich client set. What we do is pretty simple and challenging at the same time. We help our clients to grow in the digital advertising field, specializing on Microsoft and Google. And basically, the two leverages we see is, of course, offering first-class service and operations for our clients. And at the same time, we really constantly try to bring up automated solutions to give our clients the competitive edge, which gets tougher day by day. But we'll talk about that, because competition is increasing, unfortunately, for our clients. But that's our mission, and we love that mission, to be honest. That's it about us. It's definitely more about the content today, which I think can be summed up with three I think very strong sections of today's webinar. So the first section, or the first agenda point, is about macro highlights. I think it was quite a year last year, and yeah, we just want to give you some insights on a macro level. And I can sneak preview here that there are definitely some very interesting insights, and I'm looking forward to have some good discussions with my friend here. The second agenda point is channel highlights. Of course, again, a pretty dynamic year. You all know that PMax was rolled out, and it's kind of a pretty disruptive channel, and we want to shed some light on how PMax is doing, what adoption rates we're looking at, what does that mean for other channels like standard shopping. So quite interesting here. And the third area will definitely be even more point of maybe a conversation, because Mike has a clear idea on the 4 key themes for 2023. I've also my take on it, and will definitely be also a very strong agenda point, I think, because this leaves some room for good conversations, and I hope very interesting questions coming from you guys.
Yeah, thanks, Chris. So let's just get into it with the macro trends. As you mentioned, it's been a wild year. It's been a wild, like 3 years now. Like everything has been really different with the pandemic and all the stuff that's been occurring. So I want to just jump right into it and look at what happened in e-commerce in 2022. And these numbers right here, we're going to get into our data later on, but I think it's also important to give some external benchmarking as well to show, what is the context that we're operating in. So this comes from Salesforce. They have a really great free resource called the Shopping Index. Have a look at it. And yeah, in a nutshell, usually you like to see bar charts that are above the 0% line. I'm going to venture to say, I think that's not a controversial statement. We've got 2 views on this. The left-hand chart is geographic markets, Germany, UK, and France. And then the right-hand chart are 3 large or top verticals, apparel, electronics, health, and beauty. And what we see here, if you're looking at the UK, for example, with that, that long black bar there that no one wants to see, it's like minus 17% year over year in Q2. And I mean, let's just be realistic here. We're comparing in that case 2022 against 2021, which was in the middle of this still e-commerce boom that occurred during the pandemic. This is, if you look at what happened to Shopify, it seemed like they bought this 5 years of growth in 3 months or whatever, that kind of narrative that was out there. They bought that hook, line, and sinker. We're seeing now, unfortunately, with layoffs at Google, Amazon, Meta, basically all the big tech companies, everyone went into this really robust hiring boom during the pandemic, and a lot of investments were made. And now we're seeing different reality as things return to a different level. So it's been a tough time for the market at large, I would say.
Yeah, for sure. And I definitely don't have any controversial take on it. But what I would like to highlight, guys, is one thing, and we have some other data points which show this, is that there's definitely somehow a positive trend to end the year. And we saw this also across our client portfolio, that especially Q4 turned out to be a pretty solid quarter from a year-over-year perspective, because throughout the year we had really a lot of challenges with a lot of clients, because especially Q2 and Q3 were just tough from a year-over-year perspective, and in terms of reaching the still ambitious goals. The good thing is, and we have to of course monitor it closely now going into the new year 2023, but we had a strong finish. Looking at Q4, there are reasons to it. We're going to discuss them today, but I would say that's a trend which makes me quite positive, that although there are a lot of challenges ahead, that the trend is somehow turning, and there might be a good chance for a strong rebound in 2023.
Mm-hmm. Yeah, I mean, I hope that will be the case. If we look at inflation as another macro trend here, we see what you're mentioning. I mean, in this case, the dotted line is an EU average, and looking at 3 other key markets here: Germany, France, Netherlands. UK I did not include here because this comes from this harmonized index of consumer prices, fancy name for an inflation table from Eurostat, and unfortunately they stopped providing data for UK, and I couldn't get consistent data there in that case. But you see the different outcomes here, like Netherlands seeing massively high inflation, France not as bad as the European average, Germany basically right on trend. But what everyone has in common is that this did start to come under control towards the end of the year a little bit more. And so I think that's something that everyone's really grateful for, to see that those numbers improving a little bit.
And here, Mike, and I don't want to put you on the spot here, but you had some very controversial statement in during preparation time, because you said to me that inflation is not necessarily this super bad thing for a retailer. Did I get this right? And please elaborate on it, because I would love to get your take on it.
I wouldn't say you got that right exactly. Or hold on, because I don't want to. That would be a pretty hot take. I mean, we'll see it when we look at CPCs later on. But inflation is going to be challenging for your conversion rates. It's going to be challenging for your average order values. It can affect the overall aggregate demands and the search volume that you're seeing and capturing through a channel like Google Ads, which is, you have to remember, it's a pull-based channel. It depends on that demand existing. It's not a push channel. But on the other hand, CPCs, we can talk about how much they are up year over year, and people often grumble about CPCs being up year over year, but I would actually contend that they are rather, as a unit cost, they are rather inflation proof. What you get in exchange for that click is then going to be variable if your conversion rate is suffering, if your average order, the value per click is going to be in question. But the costs seem, considering the inflation that we see, the costs, in my opinion, are rather stable.
Okay, got it. Because that's what I think also the data shows, that there's not this strong correlation between inflation and CPC development. However, I'm absolutely with you. I think the bigger part and the bigger impact of inflation will be on the shopping behavior, and we all know, a conversion dip is just hurting any retailer in the world. But we're gonna talk about this in detail afterwards.
Definitely can hit your more intangible stuff like brand loyalty. As people, if they're price sensitive, it gives them just another reason to shop around. If we look at confidence, consumer confidence, this was unfortunately more or less steadily trending downward in 2022, which is the right-hand segment of the chart over here. This data runs back through 2019, so you can see some historical context. I mean, the blue or purple line, there's the UK, and I think it's interesting to just see that they're, I don't know, they seem more reactive. They have higher highs, they have lower lows, but there's a big difference in consumer confidence between the UK and Germany, for example, and we'll see that coming to bear in the channel metrics.
Of course. And I think I would double down on that statement. I had a long conversation with our country manager of the United Kingdom last week, and what's definitely the case is that the UK suffers from high inflation and kind of a more reactive market in general. So I think the UK is in for probably relatively to maybe Germany, kind of in for a rougher year, due to the fact that inflation was somehow, impacts these intangibles in a stronger way than in other markets, and that's definitely something you have to be prepared for if the UK is a big market for you, because we definitely see here just higher volatility. Could go in both directions, but for now we see it a bit more critical than other markets.
Yeah, I mean, just that gap there in 2022, it really fell away from the other markets. But it is a double-edged sword, because higher highs as well. But then the year-on-year effects become even more painful, arguably. I mean, so what with these macro trends? I hope it doesn't need a lot of explaining, but this stuff matters. History matters, so to say, and the present matters too. This stuff is really important, and I just want to show a couple examples of that. I mean, I looked at the correlation between conversion rate and consumer confidence, which we were just looking at, And conversion rate is just an incredibly like complex, multivariate, non-deterministic system, you know, so it's hard. You'll never see. I would be suspicious if I would see a one-to-one correlation between conversion rate and any other metric, basically. But given that, in the UK, we see really a pretty strong correlation between conversion rate and confidence at 0.7. A maximum value there would be 1. And by the way, and you know, an inverse correlation would be -1. That's kind of the range there, -1. So this is a strong positive correlation. And yeah, we're going to see that bearing out in the numbers when we see how the year-on-year numbers looked. And just to say, like conversion rate, consumer confidence, you can kind of in your mind draw a line between these two things. Some things I've seen even stranger things. This is something from earlier in the year that I want to share. I don't have an updated version of this chart for a couple of reasons. This is looking at basically COVID stringency. In other words, how strict are lockdown measures and public health measures. It's looking at retail mobility as measured by Google. And that basically means how much are people visiting actual brick and mortar stores. And then it's looking at Google cost per click. And real quick, the black line there is retail mobility. The gray line is the strength of the lockdown measures, and the purple line is the Google Shopping cost per click. So this became less relevant as we went on later in the year because lockdown measures broadly fell away. Google didn't even keep tracking retail mobility anymore. Things more or less returned to normal at a certain point. But you could see for a while there that like there's this obvious inverse correlation between lockdown intensity and retail mobility. So basically when lockdowns are stricter, people don't go to stores as much. We know this. This is what drove that e-commerce boom. But what was really interesting to see is that the cost per click got wrapped up in this as well. And there was a really strong correlation between retail mobility and cost per click. And so basically when retail mobility was up, when there's more offline visits, it was getting more expensive to buy clicks online. And so we're in this very complex system, and we might think, oh, my campaigns suck, or is it something about my web shop? Maybe, but there's these other factors out there too. So we're bridging the gap here then from these macro trends into the channel trends. We've seen that these things can be correlated, that they can be related. So here's like a very high level view for the UK and for Germany about what we saw. And this is basically, these are index values compared to January 2021. So that we can show you the volume of clicks, the volume of impressions, the volume of conversions without revealing the specific numbers. And basically, when you're below 1, you're below. This means that you're seeing negative year-on-year effects. And no surprise, we saw that in the UK. Consumer confidence was actually really pretty high in 2021. It was still in the middle of this e-commerce bubble. And so the numbers were great. And in 2022, the numbers came down from that euphoria a lot. They came back down to reality, so to say. The positive note is that, particularly with conversions, the blue line in the UK chart, you can see that in November and December, this started correcting itself a bit. So that's something that's really positive.
And that's the slight indication that we have a chance to have kind of a rebound or bounce back with 2023. Of course, there are a lot of macroeconomics, the big leverages we can't control, which will highly impact that. But especially in the UK, we saw this rebound, and hopefully this momentum carries over into Q1. One thing I would like to add here, especially for the UK, and I would be highly interested in your take on this, ladies and gents. One major challenge we also faced with our retailers is that the goal setting for 2022 was somehow not, I would say, adapted to the new reality, so to speak. So this idea of constant growth which of course was there for years, was still the game, right, for the goals, especially for online retailers. So there was this anticipation to have a strong growth year in 2022, and when reality kicked in, this was a real challenge to adapt the goals, adapt the budgets, and to also live with this new reality. And this was not a special thing for UK, but in UK it was just, as the numbers show, the reality hit, so to speak, was just a bigger one compared to Germany.
Yeah, and in Germany, the challenge was more, if you look at that gray line below index, the challenge was more on visibility itself, and that gap widened over the course of the year, where if you would look at it as kind of a full funnel conversion rate instead of a click to purchase conversion rate, if you look at the impression to conversion rate trend, that trend wasn't so positive, but generally it was not as painful of a situation as what was faced by merchants in the UK. And so just spending a little bit more time with UK and Germany here, we can see in this case the bars, the gray bar are the 2021 revenue numbers indexed, and the black bars are the 2022 figures, and then the purple line is the year-over-year change. And we see that the year-over-year change, unfortunately, the zero axis is on the right-hand side. It's the zero line is way up there. Most of the year, it was well below that zero line, which is somehow consistent with what we saw from the Salesforce data. We know that it was a hard year. But on the other hand, there was a positive trend where it was starting to return back to a baseline by the end of the year. And even in December, it exceeded. It was a strong December for retailers in the UK.
And that's something we just want to share with you. And it's very hard to nail down one specific reason, but usually, and I think it's no surprise to you guys, that you have this classic Q4 seasonality, that the spends go up, search volume goes up, basically conversion rates, average order value. So there's a lot of positive momentum, and we definitely saw this momentum in Q4 as well. The one thing which was pretty surprising for us here as well is that, especially in the UK, we looked at the very strong December, even compared to last year. Because normally you have kind of this seasonality-driven drop-off from November to December, because most of the retailers stop shipping from the 20th on. It's more or less not the full month, so to speak. There's just a slowdown. We definitely saw that although you had less days to sell, December was a very strong month for December, and a lot of retailers really doubled down on their willingness to spend. And we also saw a very strong and sometimes even increasing demand for the month of December, again, which gives us some confidence, although the numbers look not that good throughout the year for the UK, that there is momentum in Q4, and we have to monitor how this carries over into Q1 and beyond.
Yeah, and just in pure year-over-year terms, I think it'll be easier for 2023 to kind of compete against 2022 than it was for 2022 to compete against 21. But if we look at the same chart for Germany, we don't see that really kind of nice upward year-on-year trend. It's looking a little bit more volatile than that. But the positive thing is that it was broadly among our sample of the market. It was staying above last year, above that zero line mostly, which is great news. It could also have something to do with our mix of merchants and advertisers. You never know, because broadly speaking, if the market was struggling year on year, then they could have been concentrating market share a little bit. But we were happy with what we saw there. Yeah, and let's talk about CPCs. This gets to that point you raised earlier, Chris. Are CPCs inflation proof? I don't know that, but I mean, there are two charts here, and the left-hand chart is you'll see this dotted line. This is a benchmark CPC that we've provided, and then and it's in year-over-year terms here, going through Q3. The blue or purple line, that's Google's reported CPC year-over-year change, which they report in their earnings statements. That's why I only have through Q3, because I don't have that Q4 data yet. But you know, there was this big peak in cost per click back in year-over-year terms in 2021, and that trend was kind of relaxing, which is good. But you see that e-commerce, the dotted line, was not relaxing quite as much as the rest of Google's CPCs, because Google's providing a metric for all markets, all placements, all kinds of businesses, you know, travel, everything in there. We're talking about e-commerce primarily in Europe. So the trend was not quite as favorable for us as for Google at large. And then when we look at the right-hand chart, you can see how CPCs developed in absolute terms this year for several key markets. And I mean, the standout to me here is Netherlands, unfortunately for Netherlands, because they were spending most of the year with cheaper CPCs than Germany, but later in the year, they did cross that line. And so maybe there was an impact of inflation here, because Netherlands had very high inflation. And you have to think, it's a bit crazy spending more for a click in Netherlands than in Germany. And it's nothing against Netherlands, but think about the size of these markets compared to each other. So it's definitely a cost of living topic and so on. Positive news is that the UK in Q4 saw some relief in cost per click.
And I think in general, we discussed this before, and that there is some stability in the CPC development. If you look at from a catbird seat position, which I think is great news, because if you look at the consumer price index development, especially Q1, Q2, and you saw the Fed statements, whether it's in the US or Europe, this was definitely a pretty concerning development, and we were closely monitoring the CPC development because we anticipated a stronger correlation, to be honest. Now, 1 year in the books, I think there's some confidence that, I think, Mike, the statement that the CPC is inflation bulletproof, I think it's too much of a statement, but it's definitely not that big of a correlation, which a lot of people anticipated. And I think this is definitely good news. But bear in mind, inflation can, of course, impact other stuff, which of course is as deciding as the CPC, like average order value, conversion rate, shopping behavior in general. But from the CPC front, Mike, I think it's fair to say that the numbers could have been worse.
Yeah, but exactly right. It could still hit your revenue per click in the end due to,
that's for sure,
due to those other parts. But we've been talking about kind of the revenue and the economic sort of connections here, but let's look at what else is going on. Shopping competition increased. I mean, what's interesting here is if you draw in your mind's eye in the middle of the chart between June and July, if you kind of split that in half, you'd see that the first half of the year was more or less at or below the 0% year-over-year mark. Competition seemed down, but then, I mean, overall, there is an upward trend across the year, and that really kicked into gear in the second half of the year. We saw competition picking up, and this is a measure of unique competitors at the account level per advertiser. So you're seeing like the change in what the median advertiser experienced in terms of competitors. And everybody's favorite competitor, I would say, or least favorite, is Amazon.
I would challenge that, Mike.
Yeah, so this is zooming in on kind of the key shopping weeks, or like really the key part of Q4, even like October, November, and December here. And we saw that basically Amazon's competitive power was, you know, plus or minus 6%, some swings in there. I mean, manageable. It looks to me like some noise maybe, and but you can't say that, oh, Amazon really ratcheted up their strength or something like that. And competitive power here, by the way, is just it's a calculated metric. It's just a blend of like their impression share, their overlap rate, their outranking share in terms of shopping placements. So they were consistent, but there's a punchline here, sadly. they were consistently dominant. So those numbers didn't change that much year over year, but this is a view of how powerful Amazon is per vertical at the yearly level, the annualized level. And so the way to read this chart, this is a box plot where it's basically a min, max, and middle 50%. The handlebars on each of these shows the full range that's seen among all of our advertisers, and then the box is showing you where like 50% of the data is. And so when you're seeing these bars, it looks like music sliders or something on a DJ booth, or I don't know what. You're seeing them shifting up and down per vertical. That's basically the average of how strong Amazon is, changes per vertical. So they're weakest in furniture, and they're really strong in electronics, no surprise, in home and garden. But the fact is that they are a big, huge force in most retailers in their auctions. This is a solid presence.
Yeah. One thing, maybe just from my perspective, and I had several discussions with our clients in the sporting industry. We saw that even in case by case with our clients, and it was somewhat surprising that the Amazon really starts also to show strong presence in the sporting goods industry, because in general it was always the trends that sports, fashion areas where Amazon was not that active for obvious reasons, and this somehow is not the case anymore. So to all the sports industry listeners, I would love to get your take on it. Maybe also a part of the Q&A that you bring up some stuff from your experience. But this was somehow surprising to me. But it definitely was kind of proven on case by case level, because we had some clients which specifically highlighted, guys, what is going on? Amazon is really eating up market share here. The rest, yeah, as Mike said, just I would say a pretty prototypical Amazon picture, unfortunately.
Yeah, sadly. That was one nice thing in the pandemic. It was when they dropped out of the auction for a while. And by the way, we saw CPCs drop as well. That's another drag on CPCs is Amazon.
They have market maker capability, unfortunately. Mike, one question, if you go back, sorry, just sure. Do you have any numbers for fashion industry?
Well, that's the left hand one, apparel and accessories. That's okay. Your fashion right there. And so I mean, you'll see, like, if you look at the min that has the lowest observed min, along with maybe sporting goods.
Yeah, makes sense.
Home and garden. Yeah, home and garden. That it is the whole population has shifted up a little bit. They're pretty strong there.
Got it. Thanks, mate.
Speaking of competition, well, yeah, I'll explain this because now I want to show you PMAX adoption, and we'll talk about how that relates to competition a bit. There's two charts here, and they're based on the same data, but they're two different ways of looking at that. So the left-hand chart's pretty straightforward. You're seeing the percentage share of monthly costs that are going toward shopping, ads, automation. So because this data set goes back to January 2019, it's a long-term view on this trend. And so this is including smart shopping and PMAX lumped together. And yeah, then they're basically competing for a share of wallet against standard shopping. And we see that numbers up and up and up, crossing the 60% mark. And actually in our kind of core client base, I would say it's even higher than that. Is that right, Chris?
Yep. Yeah. Yeah, definitely.
So, but this is not a perfect representation of the market. I think some markets I've heard are up to like 80% share, and others might be less. But we do have, for example, an awful lot of German merchants, and the German market has been a bit more hesitant toward accepting automation from Google. I'm tempted to make a joke here that's maybe a smart thing to do, but I'll try to play nice.
Go for it, Mike.
Yeah, no, I mean, well, you know what? If the Germans have like this cliched reputation for engineering, I think that they do like to engineer their ads accounts, and they like to understand what's going on in there.
By the way, I think it's a good thing. They like to hack the system and control the campaign types. I think it's hard to make a general statement, but yes, it is really like, and of course it's always a use case driven thing. But I would say that more than this is kind of a German specific thing, that they lack kind of this shopping ad automation adoption. I think what we definitely see is that still that the bigger the retailer, the higher the spends, that the more hesitant players are to give away control to a certain degree by activating shopping ads automation. I think we're kind of indifferent on that question, but I fully understand retailers to be hesitant, because control is a big thing, and maybe we can talk about control as part of our PMax chart here.
Yeah, definitely. I think automation is one of our themes, so we'll have a minute to talk about that for sure. But the right hand chart, just really quick, it's showing things a little bit differently. And so you're seeing with the light gray area, that's the standard shopping share of spend, and you're seeing that decrease over time. But I wanted to then just break out the standard shopping and the smart shopping, which I did not break out in the left-hand chart. And so you can see this purple area that absolutely steals all the gray area there. That is the adoption curve of Performance Max. That's what it looked like. And so, I mean, on the one hand, this has been a very dramatic shift in the market. You can visually see it there. Just that's explosive. That purple corner there, that's explosive. But then if you look at the left-hand chart, you see that it didn't really change this slow, steady march of adoption of automation in the end. It just, it changed the specific type of automation that's in use. And so, of course, that has consequences, but it's a really interesting area to see, I think, these two charts side by side. I find it interesting anyway.
Oh, for sure.
So, you know, that wraps up. We've been looking at a lot of charts, talking through some data. And now let's just get a bit more conversational. I don't know how we're doing on time. Actually, I'm terrible at time management.
I have a look at it. If we want to answer some questions, Mike, we have to be pretty sharp now with the next slides.
Forgive me. Forgive me. Well, we want to talk through some themes quickly here. Automation being the first one. And I'll just put an opinion out here quick. Like, we see that trend has just been ongoing for years now. And I guess to me, the thing that's going to be different this year, we mentioned this word hacker earlier, and maybe the German market, for example, there's more like hackers or tinkerers in there. But I think that there are three kind of groups. There are these hackers who like to have a lot of control over what's going on. They might try to customize automation as much as possible. And I don't want to have any like connotation, good or bad, toward any of these groups exactly. But then there's like harmonizers, I might call them. Maybe it sounds more positive than the others, but these are people who are accepting the automation more at face value, you know, for better or worse. And they're just trying to think, how can I fit this thing into my account and make it play well? Like, what is the role of every campaign type in here? And then there are like these holdouts, and those are the people who are not adopting automation. And I think that there are very good reasons why. I really don't want to like praise or demonize any one group. But I do think that the size of these groups is going to shift. I think it's going to get harder to be a hacker because Google might start removing loopholes that allow that kind of stuff. I think if you're a holdout, you're going to be under more pressure than ever from Google and from like a lot of different standpoints here. And so I do maybe recommend thinking about this more harmonized approach, like just thinking about the balance of campaigns in your account strategy really carefully. And that could mean that standard shopping is still part of your portfolio if you're adopting PMax. I think it should be. I think there are use cases there. But it might, like, I'm not convinced about these feed-only approaches, for example. I'm just not convinced about that. I think it's worth testing. But sorry, I'm rambling here.
No, all good. Mike, what I would like to share with you and with the listeners, and maybe you have a different take on it, but what I'm pretty convinced of is now with the increasing adoption of PMax, and let's face it, that the adoption will be increasing throughout 2023. That's what Google is pushing, and let's face it, PMax, doing it the right way, can really be a great new campaign type. But what I think is, and I'm pretty convinced of it, it's more important than ever, and I'm talking about PMax now, to unleash your hacker mindset, or your hacker gene, so to speak, because there are definitely less loopholes with PMax, to open the Google system to untap competitive advantages. But if you're able to untap it, it can be a sustainable, big competitive advantage. And when talking about PMax, there's no bid anymore. There are a lot of areas you can't really put your thoughts into it. What I can tell you, ladies and gents, and of course this is part of automation, be very, very sensitive and thoughtful about your campaign generation, because this is the one big leverage for your PMax campaigns. If you have the right idea how to create a campaign structure which gives you the chance to force Google make decisions fully in the interest of your business objectives, you can realize significant competitive advantage. We see this across all of our client portfolio, and that's what I would like to share with you. Be bullish about your hacking mentality when it comes down to PMax.
Yeah, I mean,
I don't know how you see it, but I really, really believe in that going into 2023.
Yeah, I mean, I want to second what you say there. We should move on to some other points because of the time constraints here, but yeah, definitely. I think it ties into the next themes here, like with testing as well, because if everyone's using PMax out of the box the way it is, then everybody's using the same technology. It's hard to see how you could have a differentiation. I think it's really important to have kind of the right inputs, the right output measurement as well. Which brings me to pricing quick. You were just saying the bid is gone. So I think that one statement I like to make, a little controversial maybe, but that pricing to a certain extent is the new bidding. Yeah, I mean, I think there's different reasons why it can help pace demand and stuff, but pricing is an area that people need to get serious about, also because Google seems to be really looking at this topic next too. It seems like they've got some interesting betas in place where they're going to apply automated discounting. They seem to be onto it, because for them, if they can ensure more consistent pricing, then this helps them compete against Amazon from a user experience standpoint, for example, where pricing has typically been Amazon's value proposition. And honestly, if you land on a search engine result page, there's no guarantee that you're going to see the best pricing there necessarily. So I think that's an important topic.
One thing I would like to add here is, and this again, we see this across our client portfolio, is that first, pricing data is most of the time available. The big challenge for a lot of retailers is to make them an input for the campaign structuring and decisions in the Google advertising or Microsoft advertising field. So if you're not using price data already, then of course start doing so, and really think about making them an operating part of your campaign decisions. This is a huge impact, because we must not forget that on average 80% of your PMax campaigns are running through shopping. And for shopping, price is one of the biggest indicators of getting a conversion or not. So please keep that in mind, and pricing should be a key topic for you going into 2023.
Yeah, I agree. And for people who might say, well, isn't pricing an auction signal that Google considers in their bid? I spoke with Google, and they would not confirm that to me, but it doesn't matter, because that's at an auction basis only. It's not thinking about your pricing holistically. It's not thinking about your pricing strategy. And you still should put some influence there, because you don't want something that's operating on a per auction basis deciding your pricing, which is ultimately deciding, like, there are two big points in your profit, and that's how much you bought the thing for and how much you're going to sell it for. So I would not delegate that.
100%.
Yeah. Testing. Okay. we don't have a lot of time here, but I think a big question for Performance Max in particular, and I don't only want to talk about Performance Max, testing is so important in your whole ads account. Let's face it, different setups, different structures, and so on. But if we're talking about Performance Max quickly, I think that, yeah, the numbers look good in platform. I don't think anyone can say that. I mean, if you're spending enough money and you've got a halfway decent website and inventory, it should do pretty well for you in terms of the in-platform performance. But the question that's left open in my mind is it really working hard enough? Is it actually incremental? Is it really generating sales that wouldn't have occurred otherwise? Is it on the products that need advertising pressure, not just the ones that are easy to sell? You know, there's controversy about the brand traffic and so on. And so I think testing is a key way here that we have to get serious about in 2023. Anyone who doesn't have a serious roadmap, and the big almost buzzword at this point, but actually it's a marketing fundamental, incrementality testing. So in the interest of time, let's jump to unsung heroes. And this is simple: diversify off Google, or let's say that you're a direct-to-consumer brand and you're really heavy on Facebook and Meta and Instagram. Diversify. I think it's going to be really important to look for opportunities. And one unsung hero that I want to particularly call out is Microsoft Ads. You know, it's not always the most glamorous ad platform out there, but it works. Like, if you check it out, try it out. If you're not investing there yet, have a look. See, is my audience there or not? Because shame on me, I don't have these numbers top of mind, but I was reading some research from Microsoft. They looked at how many unique users they have that are only available on Microsoft and not on Google.
It's 9 million in Germany alone, for instance.
Yeah, that I was like, do I dare say it? That's right. It was, I have that number in my mind too. 9 million users that can only be reached through Microsoft Ads. So think about it, because when we're talking about incrementality, again, that's something that you're just leaving those customers on the table. You're not even leaving the revenue on the table. You're leaving those users, those customers on the table.
And most of the time, ladies and gents, it's really a quick win. There's so many Microsoft accounts which are just running without getting any attention, and sometimes rightfully so, because the revenue and cost share is just so low. But even if it's low, if you do some minor optimizing, Microsoft can just be a very, very profitable channel. And talking about incrementality, 9 million unique users you can only reach with Microsoft. That's pure incrementality, right? This is big. So our message to you guys: if you already do Microsoft, let's just put a bit more focus on it. And if Microsoft has never been a part of your strategy, start right away. This gives you incremental revenue no matter what.
Yeah, I agree with that. And there we are. I think if we still have time for questions,
it will be a tough one, and especially, guys, because I looked it up in the meantime. There are definitely a lot of questions. I stopped counting at 13 questions still coming in. So as Mike said, unfortunately, we really have some time pressure now. Every question will be answered in a direct way in the aftermath. This will be done till tomorrow, end of Friday end of business. And I would say we might 3 questions. There I pick 3 to pick 3.
Let's go.
It's kind of somehow an egoistic move. Now the questions I'm most interested in. One question I love is, and Mike, I can't answer this because I will put you on the spot here. One question was, what is your prediction for 2023 regarding CPC development?
Okay. Yeah, I mean, I showed the absolute values for the year 2022. If we had zoomed out a bit, we would see that you know, there was a lot of CPC discounting that occurred during lockdown and during the pandemic, the acute phase of the pandemic, and that then things actually, yeah, they normalized a bit. They went back toward 2019 levels, and this was perceived as a strong year-over-year increase. And in some industries and in some weeks, by the way, they increased a lot. But in the UK, it was just a relentless march upwards, actually. So it was relatively stable this year, which is nice because it's just been climbing and climbing. But to get to the point, supposing that we have a partially recessionary environment, which is totally unclear if this is ever going to happen or not. Is it really a recession? Isn't it? If we see reduced aggregate demand, then I would expect that we see an environment similar to what we saw during the pandemic, where you'll see basically, because what that means is that the ad inventory that is available might be in surplus of the search demand or the advertiser budgets or so on, and in that effect, it could become cheaper to buy inventory. So if there is a recessionary environment, the plus side of that is that we should see cheaper CPCs. Yeah, so I'm hoping that we're going to see relatively flat movement this year.
Okay, got it.
Or a cool down.
Another question I think is a heck of a question. I guess everyone is interested in. One listener asked, what do you think is on the roadmap for PMax going into 2023?
One thing I appreciate a lot about PMax, it's not my favorite technology. The way that it's built, the way it's designed, I won't be shy about that. I think that we have to use it and experiment with it at least. But I really didn't like Smart Shopping, and I like PMax better because there's more that you can do with PMax. It's a bit more of a sophisticated product, and I think that Google, one thing that they're doing well is bringing more insights, and it may not be the insights that we had or the way that we'd want them. But for example, there is a form of search term reporting available now, and there's more reporting coming toward like how assets are performing and so on. And so I think what we'll see on Google's roadmap is going to be more insights, and I don't know exactly what those are going to look like, but I'm hopeful that they're going to be helpful to us.
I second that. Mike, let's live on the edge and just go for one more question.
Okay.
And I love putting you on the spot. This was coming in late. It's referring to a statement. You stated pricing is the new bidding, and the question is, what do you mean by that?
Okay. Oh yeah, I didn't. I was kind of rushing through there. Yeah. Price. This comes down to price demand elasticity, and yeah, I think it's an interplay. It's a game everyone has to play, or let's put it in more scientific terms. You can test this stuff and you can try to model it or understand it, but basically, if your price is going to do things like increase your visibility on the one hand, which is great, or increase click-through rate, these are positive effects. If it might also increase people's willingness to actually click through and buy, so it can have an improvement on the visibility side. It can have an improvement on pushing people over the edge on the intent side. The trade-offs here are what's happening to your profit in the end, and another trade-off is going to be what kind of customers am I acquiring if I'm discounting? Are these the people that I actually want to acquire? So this is going to be, if we link that back to testing, I think pricing is one of the last big levers that's left open when bidding has been taken away, when a lot of promotional controls have been taken away. Pricing is still in our hands. It's still something that we can control in Google Shopping, in Performance Max. And so I think getting serious about your pricing and asking yourselves these kind of questions is going to be significant.
And using that data to steer your campaigns.
Yeah.
Very, very important. Because a lot of times the pricing is some isolated data somewhere in the company. You should, as an online marketing specialist, really be actively working with data and make decisions, especially for PMax regarding your campaign structuring. Because as Mike said, one of the last leverages you have. I really would like to add this because I second that 100%. So Mike, that's it for now. Ladies and gents, thank you very much for your time. Like I said, we will answer all direct questions until tomorrow, which is actually Friday, end of business. And I just say thank you very much for your time. Was a pleasure, Mike. And we see you around, Mike. And to the listeners, I wish you a great rest of the week. Thank you very much for your time.
Thanks, everyone, very much. Take care.